It is now justified for the Fed to raise its key rates. In the third quarter, domestic demand was up by 3% and unemployment rate has reached low levels at 5%. The zero interest rate policy is no longer justified as domestic growth seems more solid than in past quarters. Moreover, there are now lower concerns on China, financial markets, and the outlook on inflation. The recent releases of US indicators have probably comforted the Fed FOMC in its scenario. Fed expects a 2.4% GDP growth next year, a rebound in inflation to an average 1.6%, and a 4.8% unemployment rate. There are 3 points the Fed has to consider when it will raise its interest rates. First one, the level and the behavior of real interest rates. Second, the volatility in markets and in the real economy. We know that the housing and the auto markets have benefited a lot from this cheap money environment. The manufacturing sector, and particularly energy, could be sensitive to a change in financial conditions. And the third point is the level of the US dollar, as it is always prompt to price in and reflects any changes in interest rates and in Fed's communication. The Fed has now to imagine a new non-conventional path of normalization of its interest rates. It is impossible to push key rates back on the levels that prevailed before the financial crisis, around 5%. The Fed will probably adopt a risk management approach. If tightening begins in December, the Fed will not hike on a regular or quarterly basis. It should stay pragmatic and not adopt the same strategy than in 2004. The Fed had recognized that the neutral rate, that is the equilibrium rate for the economy, is nowadays closer to 0% in real terms. All in all, this means that the Fed will hike by 25 basis points in December, followed by another 25 bips in the first quarter. Thereafter, the bank will watch for the reactions in the markets and the economy. The Fed action will oblige other central banks to adopt more aggressive monetary stance. The Eurozone and Japanese economies are well behind the US in terms of economic cycle. The monetary support is still totally justified. The ECB and the BOJ will probably adopt new measures and the divergence will increase further between the Fed and non-US central banks. Next year, central banks will write a new chapter of the monetary policy. For the Fed, it will be a non-conventional normalization path, and for ECB and BOJ, a diverging and more aggressive episode. Currencies will react a lot to this new monetary regime. The key question is now how long and how far the US economy and the Fed will accept the rise of the US dollar.